Hello, everyone. Today on the Final Bar, my guest is Larry Berman from ETF Capital Management in Toronto. We'll talk about some charts that are top of mind for him, trying to make sense of this environment. The S&P going through what we might call a digestion day. If yesterday's distribution was the meal, today's the day we sort of digest that sell-off, sort of chop around the zero line. The S&P finishing not far from where it started, or really from where it ended yesterday, revolving around 4,400. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets using the power of stock charts, using data visualization techniques, technical indicators, and a pure analysis of price as much as possible to make sense of this market in uncertain times. We've seen plenty of volatility, plenty of uncertainty, plenty of fluid movements. With days like yesterday, matching or days earlier in previous weeks, where we had acceleration to the upside. We're sort of all around a lot of stocks pulling back to key moving averages. We'll try to highlight a couple of those because it's not a huge earnings week, but there are a number of companies, particularly the big box retailers, some apparel retailers, and a lot of them really at key junctures. Some of them really rotating to the upside, showing some renewed strength. Stocks like NVIDIA come to mind. But also stocks sort of testing support levels, testing their 200-day moving average. No shortage of stocks breaking out and no shortage of stocks breaking down. We sort of have plenty of both to talk about. So a little later, we'll do a segment called The Bottom Line, where we focus particularly on earnings releases this week. We'll hit on some of the key charts you should be aware of. We have a great guest today, Larry Berman. Larry's been on the show before, does a really good job of just making sense of the market, talking about some of the big picture themes. Next week, we have Kathy Donnelly, author and trader, on Tuesday, the 24th. On Wednesday, Katie Stockton from Fairlead Strategies joining us from Connecticut. On Thursday, the 26th, John Kosar from Asbury Research in Chicago. Coming up next Friday is our latest episode of The Pitch. The Pitch is a monthly show where once a month we invite three strategists on the air to each present 5 ideas, to pitch you their ideas, and then we discuss them as a group. I'll be moderating a really fun discussion with 3 guest experts. For more information, go to stockcharts.com/thepitch, where you can watch all the previous episodes on our on-demand platform, stockchartstv.com. Let's continue on with today's market recap. As I mentioned, if yesterday was about distribution with the rollover, with the sell-off going right into the close, today was the digestion day. Today is the break you take after a big meal, let things get digested before you decide whether you're going to jump in the pool or whether you're going to do whatever's next. And we're going to have to see which way the market resolves, where it takes things tomorrow going into to next week. But overall today, really chopping around the zero line. Now, underneath the hood there were plenty of potential movements or plenty of dispersion, plenty of stocks going higher and going lower. The mid cap and small cap index X's, for example, are both down today, 0.8 to 0.9%. The NASDAQ 100, on the other hand, up 0.5%. And that's really driven by technology leading the way higher. The cyclicals, things like energy, materials, industrials at the bottom of the list today. The VIX continues to go higher. And if the VIX is a measure of volatility, which it is, if it's a measure of uncertainty, which I would say it is, if it's a measure of fear, which it can be, but it's really a measure of volatility more than purely fear. It's above 21, nearing 22 again. Again, this was at 15 something not too long ago, last week. So it's really rotated higher in a pretty significant way. Let's look at some other asset classes very quickly, then we'll dig into the charts with the time we have remaining. So interest rates coming off today, although it was really out of the open that you saw interest rates lower. They didn't churn around too much after that initial drop in yields and the initial rally in bonds, with the 10-year yield down around 124 and the long bond ETF, the TLT, up about 0.75%. The dollar index higher and about 0.5%, and the UUP is above 25 for the first time in quite a while. Today really struck me as I was going through my morning coffee routine, sort of analyzing the same set of charts every morning. the dollar going higher, commodities rotating lower. Almost jumped off the page at me as I was flicking through the charts. We'll hit on a couple of those later in today's show for sure. Commodities as a whole, relatively weak. Gold, probably one of the better of the bunch, but still down about 1/3%. Crude oil continuing to push lower, and as I mentioned, energy, the worst of the 11 S&P sectors today. Cryptocurrencies back in recovery mode, back in all is well mode, back in long and strong mode. Apparently, at least for today, with Bitcoin, with Ethereum, both up 4+%, and across the board, a lot of green when you're looking at cryptocurrencies today. A lot of those, particularly Bitcoin. You had this rotation above 42,000. I think that was key. We've remained above there and now chopped around quite a bit, but really today continuing that push down to the back to the upside. And I think you've seen a very much a rotation of Bitcoin from bearish phase to bullish phase, or from distribution phase to accumulation phase. I put a couple of videos on my YouTube channel last week, particularly talking about Bitcoin and the 42,000 level, and then a couple different scenarios to think about what could be next. So go to my YouTube channel, Market Misbehavior, if you want to dig into that in a little more detail. So here's what a chart of the S&P 500 looks like after today's close. Again, today from yesterday, really not much of a directional move. We remained right around 4,400, but opened lower and sort of rallied back to finish where we're at. We're still sort of where we were about 5 weeks ago. We haven't changed a ton, even though obviously we made new highs and came back. But overall, we haven't made much progress since late July in terms of the overall trend. Now, what that means is that the 50-day moving average going in an uptrend is getting closer and closer to where we're at. We're a day away at the very least from the 50-day moving average, meaning today or yesterday or tomorrow, if we would drop lower, it's very easy, very accessible to get to the 50-day moving average, and that would be about a 3% drop from where we were, end of last week or beginning of this week, as we made new highs there. That's not much of a drop, right? I mean, the average sort of pullbacks, when you look back to the meaningful pullbacks, it's been 4 to 6% on average. The most recent one in July was about a 4% drop from peak to trough. So again, it would be interesting to see a 5% drop, which would take us back to the July low. This red line for me, I would say, represents that first line in the sand. Holding the 50-day would keep it consistent with the trend that we've seen in 2021. I think breaking that is certainly going to cause a lot of people certainly draw their attention to what's happening with the S&P. Holding that red line, which is around 4250, 4240, I think would be key, because what's happened is every time the S&P is pulled back, it's made a higher low and it continues higher. And that trajectory, that overall trend of higher highs and higher lows, is sort of that classic Charles Dow uptrend continuing to push higher. You're looking for when that pattern breaks, which would mean we would need to hold 4250 or so on a pullback to make sure we still have a higher low. And then if we would rally after that, you'd want a high above 4450, 4460 to make sure we continue to keep making higher highs. At this point, when you get a bit of a pullback this week, those are the levels that I would start paying attention to closely to see if we're able to hold those levels or not. As I mentioned again on the sector rotation, we had technology number 1 up 1%, real estate number 2 up 0.9%, consumer staples number 3 up 0.8%. So sort of a mix of growthy leadership and defensive sectors at the top of the list. But the cyclical stuff, the things that had been leadership for quite a while, energy, materials, financials, industrials, all sort of rotating lower today. And while some of those are holding support okay, there are plenty of stocks that are not. And I was looking at some stocks that had broken their 200-day moving average. I did not have to work very hard in the energy sector to find a lot of stocks that are sort of in that scenario, right? You have Suncor, SU, and many other stocks, integrated pipelines, others that are sort of rotating lower. Now, not all of them obviously breaking their 200-day moving average around the same time. There are different trends at work there, but on average, this is a sector that's rotated from an accumulation phase to distribution phase. And stocks like this being unable to hold their 200-day moving average, I think, is a bit of a concern. What's interesting now, you have stocks like Disney and Tesla and others that are also testing their 200-day moving average. My question would be, are they able to hold those key levels of support? Do they continue to rotate lower? Again, it's not just within energy. In many sectors, you're finding stocks that are breaking through some of those key support levels and continuing potentially to push lower and lower. Wanted to check in just very quickly on breadth. We talked about breadth conditions earlier in the week. We had a segment banking on breadth where we focused on some of the particulars. I think it was on yesterday's show. This is the chart when we recorded the show, it wasn't quite updated with the breadth data from yesterday. This is what that chart looks like. And this is using my very subjectively color-coded chart showing the cumulative advanced decline lines for the S&P 500, which is in green. And that represents the fact that the S&P has continued to make higher highs every month, made new all-time highs every month. And the cumulative advanced decline line has continued to trend higher, has not even broken its 50-day moving average really for the course of the year. Compare that to the one in orange, which is the mid-cap advanced decline line. So really made higher highs into June, and then that was sort of it. We haven't broken down a ton, but it stopped going higher, right? And I think that's the case for a lot of individual stocks that you might bring up. It's not that they're that they're going down necessarily, although plenty are. It's that they're not going higher, right? They've stopped the uptrend. They were just really haven't continued a huge downtrend just yet. It's kind of what the mid-cap breadth looks like. The small cap breadth and the NYSE breadth using common stocks only for me is still quite distributed. These are color-coded red. These are advanced decline lines that have rolled over. Not only have they not made new highs, but they've made lower highs. They've made lower lows. And the bounce we saw last week kind of rotating into a new swing lower so far this week. I'd be very keen to see if those July lows are able to hold on those or if those start to break. And I think something like the mid-cap breadth can very quickly look more negative if you start breaking those support levels. When we come back after the break, we'll talk with my guest, Larry Berman, touching on some of these themes, including a beautiful chart talking about seasonality for the equity markets. We'll be back with you in just a moment. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we break down the activity in the markets from a technical perspective. As a reminder, we're going to be going back to live at 4 p.m. Eastern starting next week on Monday, the 23rd. So look forward to having you join us at that time live. We will continue to push our content out via YouTube and via StockCharts TV on demand at the normal time, so you can get it then. But we will be back live at 4 p.m. Eastern starting Monday. A couple quick announcements before we get to my guest, Larry Berman. First off, we'd love to hear from you, particularly questions that are coming up as you are analyzing your own charts. Anything about technical analysis, about particular charts or ratios or sectors that you're looking at. We're here to help point you in the right direction. You can get your questions to us one of three ways: via email, thefinalbar@stockcharts.com, via Twitter @finalbarsctv, via YouTube. Just put a comment below the video that you're watching. We'll gather all of those questions and hope to answer your question on our next mailbag segment on Friday's show. Also, go to stockchartstv.com. You can use your email address, set up a free account, start watching all of our great content immediately from our website, also from your mobile devices. Great guests like Larry Berman and others, shows like the Final Bar, special events like The Pitch and Charting the Second Half, all featured on stockchartstv.com or on any of the app stores. Just search for StockCharts TV on demand. I want to welcome on today's guest, Larry Berman. Larry's the founder and chief investment officer of ETF Capital Management in Toronto, joining us on the show once again. Larry, welcome back.
Thanks, David. It's always exciting to chat markets with you.
It's a pleasure as always, Larry. And you're starting us, talking about the S&P and the market recap. We're talking about this market that continues to push higher, but potentially some concerning signs underneath the hood. Start us there with the breadth. What are you seeing?
Well, in our series of indicators that we look at, market breadth is an important factor. And I look at shorter term, so the percentage of stocks above the 50-day. I look at the percentage of stocks above the 200-day, and then we factor in the McClellan Summation Index as another great breadth tool to analyze. And what we started noticing a few months ago in April and May is the significant decay. And this kind of speaks to the notion that the average stock has actually started to underperform. And it has a lot to do with the reopening and the growth versus value trade and so forth. But you can see that decay in May where the markets were sort of grinding higher there and fewer and fewer stocks participating. Now, I put a simple regression of the last month of price. That's what the red lines are. So there's no divergence at the moment, but the whole picture is really a divergence in itself when you're looking at what's happening with small caps, the average stock. And you're seeing, fewer and fewer stocks lifting the market, and it tends to be in the S&P, large cap technology. So, how much longer is large cap technology going to continue to lead the world here? And that we can debate probably for hours.
Day like today, obviously the S&P flat, technology up, the cyclical's kind of down. It plays to what you were just describing there. Your second chart is really addressing the seasonal trends or perhaps the seasonal challenges. Talk us through this chart.
Yeah, so on the top graphic here, we have in percentage terms in blue, the 1 month forward return of the S&P 500 based on where we are seasonally. So this chart goes back to daily data for US large caps, now called the S&P 500. Wasn't always 500 stocks, as we know, going back to 1927. And we basically take the first year of every presidential period, which we're in now, and we say, well, what on average is the forward-looking seasonal based on where we are? And on the bottom, we have this statistical measurement called a Z-score effectively, and we've normalized that between 0 and 100. And when we're in the worst return section, the high caution section, right, where we are for the next couple of months, on average returns are negative. Now, not massively so, but as a bias. So when you start to see the decay in breadth and it's broadening out, and you get into a period of weak seasonals, you factor in what the volatility, the difference between the current VIX measurements and future the VIX curve. You start factoring in all these things, David, and you say, this is not the time to be aggressive on the upside. This is not the time to be buying dips. If anything, it's looking at risk reversals and ways to hedge your portfolio and whatever that means to you to be a little bit more defensive this time of year.
So it's two fantastic charts, Larry, and I just a couple questions if I could. So, when you're thinking about the markets now, you're thinking about the S&P going higher. A day like today, where you've had things like real estate, not just today, but in general, have actually been a pretty good performer year to date. Things like utilities starting to emerge. Is it the time, as you think about the seasonal weakness, to get defensive, to be leaning in there? Or is it more thinking opportunistically about some of these cyclicals that have already been beaten down, 10, 20, even 30%?
So that's a great question. And the answer is what's your time frame? Are you looking to be tactical for a trade, or are you looking at from an investment standpoint? From an investment standpoint, there's not a lot of value out there in the US markets. There are some small pockets. I would not call consumer staples value trading at the multiple they're trading at, but everything's elevated. So I guess it's a relative world we live in, and relatively now everything's leveraged to the fact that the Fed keeps printing more money than they're spending at the moment. But that's not going to last forever, and the taper talk is upon us next week with the Jackson Hole event.
Certainly seems like we could have some potential catalysts from the Fed. Larry, we have about 30 seconds left, but I did want to point out your second chart there, where you're showing the seasonal trends and the Z-score, the statistical measure at the bottom. That's part of your Pro Eyes segment on your website, bermanscall.com, right?
Yeah, so you go to bermanscall.com, Pro Eyes, PROEYES, stands for Probability Return on Investment Index. So Pro Eyes. So this is like the Fear and Greed Index, CNN Fear and Greed Index, but there's 20 factors. There's 12 technical indicators. There's 4 valuation indicators, and there's 4 business cycle indicators that include looking at inflation and credit spreads and then market valuations overall. It's really meant to be like a fear and greed index. We call it an opportunity versus caution index based on where the overall index now, high caution readings. The average return historically over the last 20 years when the index is at this level is around -7%. Over the next couple of months. So again, not a time to buy dips just yet.
Larry, really appreciate you coming on, sharing your perspective with us. Thanks so much. Be well, stay safe. We'll talk to you again soon.
Same to you, David. Pleasure.
That's Larry Berman. Larry's the founder and chief investment officer of ETF Capital Management in Toronto. It's great. There's so many different things we touch on that. I wish that discussion could have gone on for hours, but the interesting point is when you look at the seasonal trends, we've talked about some of the seasonal challenges as we get August, September into October. This is when the market tends to be weaker. That was actually, I like how he was actually relating it to the presidential cycle, right? It's the first year of a new president and showing how that seasonal trend really holds true going back through the historical data. Something to think about. Some words of caution. Let's continue on with our next segment called the bottom line. What we like to do around earnings is focused on some of the charts and stocks that are top of mind, companies that are reporting. Now, a couple of weeks ago, we were in the meat of earnings season, so we had our cup runneth over with charts to look at with all of these companies reporting. Here it's a little bit less. It's a little more of a trickle at this time of year, but certain sectors, particularly like consumer discretionary and others, they don't really focus their earnings. A lot of things like financials, they all kind of come in a week or two, and then you wait a quarter. Something like consumer discretionary, they tend to dribble out through the course of the quarter. And so some interesting ones this week because of the big box retailers, I think tells you quite a bit about what we may want to expect. Let's go quickly through some of these and just, again, not too much to comment on the earnings announcement, but more to focus on the charts and what they're telling us around this key announcement day. Walmart is a key one because it is sort of right back at significant resistance. And I'm always keen on a chart of a stock or of a company that's reporting earnings and you're facing a significant resistance level during that week when it's reporting. So Walmart just reporting on Tuesday, you can see this resistance level just above 150 back here in November. We're right back to that point. So after selling off through the March swing low, we've actually rotated and round tripped back to that top. The question for me would be, are the earnings positive enough to create a catalyst? A lot of times an earnings release that's successful or that's positive, a positive surprise, can push something like Walmart above previous resistance. You didn't really necessarily see that this week. It's sort of been relatively stable, relatively sideways. So far that resistance is holding. I would want to see a sustained move above 150 to sort of indicate a reversion back to more of a positive trend for Walmart. Otherwise, it's been relatively sideways. Kind of a similar story for Home Depot. Now, Home Depot gapped down on Tuesday. They reported Tuesday before the open. You can see the gap down to the 50-day, but not much of a loss. And now it's sort of remained right up around there. So the same story. You had a resistance level of 340 that was established back here in May, coming back up to that same level, 340, and then pulling back. And I should remind you, when we're looking at a lot of these charts, we're always using adjusted data, which streamlines or adjusts for historical dividends going back. So on a heavy dividend payer, you may want to do underscore HD or something like that, if you're really focusing on a key support and resistance level, especially if you're going back in deeper history, because otherwise you're going to get some weird readings on the price. Talk about a chart that's actually accelerated to the upside, Agilent Technologies. Now, we've talked about healthcare, and we've at times highlighted some of the stocks and things like medical supplies, medical equipment that have had pretty significant or consistent uptrends. Agilent is one that is accelerating to the upside. You have a pretty good pace. You've been below the 50-day moving average a little bit, but very rarely over the last 12, 15 months, but you can see that the trend is accelerating to the upside. So, some would be concerned that are we, an exponential rise? How far is too far? And I totally get it, but I have learned to follow trends like this and assume that they will persist until proven otherwise. Interesting that Agilent has actually become extremely overbought with an RSI above 80. And what that back of the envelope means for me is you usually get at least one more push higher before you'd have any sort of exhaustion signal. But certainly the relative strength is indicating the persistent uptrend for Agilent. Compare that chart with something like Target. So while Agilent is accelerating to the upside during earnings week, Target, which reported just yesterday, is actually rolling over. So you actually had a sell-off going into the earnings announcement. Target had been overbought from sort of third, fourth week in June through the end of July, and from there has kind of come off. You can see this transition of sorts from uptrend to downtrend. And the question is, does the 50-day moving average hold, or the 10-week moving average? A lot of money managers will use that as sort of a general gauge. As long as we hold that, things aren't that bad. Things are actually okay. It's sort of a healthy pullback indication. We start breaking the 50-day, then you have to start wondering, is this the beginning of a much deeper pullback? That's when you have to start debating, do you want to take some off the table? Do you want to start, finding other opportunities that are not pulling back so much. I think Target is an important chart to watch to see if we remain below that 50-day moving average, continue to go lower. That's one stock that is not coming out of earnings season too good. One that is surprising to the upside is Lowe's. Now, while the short-term action in Lowe's is encouraging, we've bounced above $200, getting above the July high. That's all encouraging. Still, the chart of Lowe's is not super exciting on an absolute basis, because again, a lot of the a bulk of the move happened here going into September. From September of last year through March, really didn't go anywhere, and as a result, underperformed the S&P. Then one more move higher, March, April into early May, and from there we haven't gotten near that previous high. So on a chart like this, I'd really want to see a move above 210, which would take us above the May high. That would indicate a nice rotation, but this is an impressive rotation from a breakdown of closing below the June low to all of a sudden making a new swing high. And now we're talking about the high from July, and that's being eclipsed. I think this is a great example of where you want to wait for a follow through. You get a breakdown, that's okay. You want to wait to see if there's a follow through. Just a couple more names, then we really have to finish off. NVIDIA, key stock in a key market. I was looking earlier at LRCX, which is in the same group, semiconductors, testing its 200-day moving average. Question is that able to hold? NVIDIA has certainly been one of the leading stocks in the semiconductor group. Compare that to something like Intel, which has been one of the lagging stocks in that group. NVIDIA has certainly been one of the winners. Now sort of consolidating. You have a lower highs, higher lows, sort of a pennant pattern. The question is, which way does this resolve? Getting above 210 would clear the way to much higher highs, but it has to hit 210 first. And then finally, I don't want to pick on Robinhood because it's just getting started here, but first earnings release yesterday. I went on Bloomberg Television yesterday afternoon talking about Robinhood and the challenges to that business and the challenges to the stock from a technical perspective. After the big jump, and sorry, this is all compressed on the right, but after the big jump out of the IPO about a week later, you've had a steady distribution. And while today is certainly gapping downwards, I don't think the downtrend is that much of a surprise given the distribution you've seen since that initial spike in Robinhood. So from a technical perspective, a lot not to like on the chart of Hood. We need to wrap the show, go to the 3 and 3 charts in 3 minutes. Here we go. We talked about the dollar index rotating higher and the move higher on the UUP in our market recap segment. This is what's called a cup and handle pattern, which is basically a rounded bottoming pattern, looks sort of like the cup. And then you've got the shallower correction where we hit about the same level. That's your handle, and breaking above that is pretty bullish. This isn't updated just yet for today, but we're kind of up here above that neckline, the pink dotted line connecting those previous highs. So the dollar index, $ USD, and the UUP, which is the dollar bullish ETF, both sort of completing that pattern, resolved to the upside. That suggests further upside for the dollar. That usually implies outperformance of small caps versus large in general, or at least a tailwind for that sort of performance, and also US versus non-US stocks. Flip that chart over and you kind of have the chart of crude oil, $WTIC on StockCharts. This is the crude oil continuous commodity contract. And you can see this rotation down. So while the dollar index breaking above the neckline to the upside, crude oil is actually breaking down through the neckline to the downside, breaking through support, following through to the downside today. As I mentioned, energy, the worst of the 11 S&P sectors. And while the commodity story could certainly work out, and I get the long-term commodity super cycle thesis, in the short term, you're certainly not seeing that. You're seeing weakness in crude oil, weakness in energy, and I don't see that changing, at least today. Finally, chart number 3, Caterpillar. With my guest yesterday, Jay Soloff, we were talking about Caterpillar and some options ideas based on the trends there. Caterpillar right at its 200-day today, closing below it for the first time since last July, over a year ago. So this is quite a rotation in a stock that had been sort of the example stock. When you think about infrastructure spending and the infrastructure bill, CAT is one of the charts I would bring up to see what people are doing about that. You can see that stock had done very, very well leading April into May, into at least early June. From there, the relative strength has been underwhelming as the growth trades, things like technology, have come in to compensate. The question is, does Caterpillar hold its 200 days that follow through on today's breakdown? And most importantly, does it close below 200, which would be a key line in the sand support? Folks, that's our show for today. Special thank you to Larry Berman, joining us from Toronto, sharing his thoughts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.